Hi, welcome to lesson 3, the 3 steps to successful investing. We've just completed the previous lesson on investing in index ETFs, basically buying the entire market. So let's now move on to the next level, which is how do you pick winning stocks that are going to outperform the market averages, buying stocks that have got value and momentum. And there are basically 3 steps when you want to make any kind of investment. And step number 1 is you want to identify very good businesses. Because if you think about it, when you're buying a stock, what are you buying? You're buying a part of a business. So what business do you want to buy? You only want to buy the best businesses in the market. So once you find a great business, do you invest in it immediately? No, of course not. It's kind of like if you go shopping and you find a wonderful shirt, it's great brand, great material, what do? You always check the price next. Is the price right? If it's too expensive, you don't buy that jacket or you don't buy that shirt. You wait for the sale to go and buy the discount. So the same thing goes with investing. You only invest when the price is undervalued or fairly valued. In other words, you're buying at a good price. You're not paying too much of a premium above what it's truly worth. The next thing is you also want to optimally buy at a low risk level, where you want to buy when the emotions of the market it's moving in your direction. So you're going to buy during a price uptrend, or at least when the price is in a consolidation phase, and avoid buying when the price is on a downtrend. Because remember, on a downtrend, low can get lower, cheap can get cheaper. So ideally, you want to enter when the kind of like the market is moving in our favor. And step 3, there are times when no matter how good an investment is, you may want to exit an investment. When the business is no longer as good as it used to be, when fundamentals deteriorate. Or sometimes you exit when the stock is doing well, but it's really overvalued. It's really too expensive. It's now reversed on a downtrend. There's nothing wrong with getting out, keeping the cash, letting it go down, and buying it back at a better price. So in general, these are the 3 steps to successful investing. Let's go through the steps now in greater detail. All right, so step 1, once again, identify very good businesses. So the question is, what makes a good business? Well, a good business is one where over time, you are confident that the business will increase in value, right? So take a look at this chart. Over time, the business will increase in value. Why? Because if the business increases in value, it will lead to higher share prices and more dividends being paid to you as a shareholder. Okay? Because over time, the price of the business or the price of the stock would reflect the true value of the business. In the short term, remember that prices are driven by emotions, demand and supply, news events, trade wars. But in the long run, if the business is doing better, the share price would eventually go higher. Okay? Now, bottom line, what makes a good business? Well, a business is a money-making machine. So the more money it makes, the better the business is. The more money it makes, the more valuable it is. So what drives value would be sales and earnings and cash flow. So again, what makes a business more valuable? Higher sales, higher earnings. Now, when I use the word earnings, it's the same as net profit or net income. It's all the same thing. And more cash flow being generated from its operations. So we only want to invest in businesses with consistently increasing sales revenue, net earnings, and cash flow from operations. So when we do that, we are sure that the company is going to increase in value over time. Now look at something interesting. This green line that you see is the company's value. The red line that you see that goes up and down is the share price. That again is driven by short-term emotions in the market, based on the trade wars, interest rates, and so on and so forth. So notice that the share price doesn't go up exactly in tandem with the value of the company. Sometimes because of optimism, because of good news, the share price may go up higher than the company's true value. So those are times when the stock is overvalued. And of course, there are times like during a recession, during a financial crisis, the share price could go all the way down below the company's true value because of fear in the market. And that's when the stock becomes undervalued. Let me just note it down, undervalued. And this is when it's overvalued. So once you know the valuation of the stock price, you will know when it's selling at a high price or selling at a low price. And ideally, as investors, when do we want to get into an investment? We want to get in when the price, the red line, it's near the green line, near the value or below the value. All right. So here, look at a few actual companies and actually stocks, right? So if you take a look at this stock of this company, Procter and Gamble, P&G. Now, this is a great business because they sell a product or they sell products that are very defensive. They are necessities like shampoo and soap and detergent, right? I'm not sure if they do detergent, but I know they do a lot of soaps and toothpaste and things like that, right? So in the long run, you can be sure that the value of P&G, Procter and Gamble, will increase in value because their sales go up over time, their profits go up, their cash flow goes up. So this green line that I've drawn over here represents the true value of the company. But you can see in the short term, the stock price, which you see over here, gyrates up and down because of, again, short-term volatility in the market. So it's overvalued, it's undervalued, it's overvalued, it's undervalued, it's at fair value, overvalued, undervalued, overvalued, and so on and so forth. So again, we want to get in during times when the price is selling below the value, and at the same time, it is starting to change its trend over there. So these are all times when these are great buying opportunities. When do we not want to buy? We do not want to buy here, for example. We don't want to buy there. We don't want to buy there because at those levels, the price is overvalued relative to its value. See what I'm saying? Here's another example on Alphabet, which basically owns Google and YouTube. And again, Alphabet's a great business because over time, more people use Google, more people use YouTube, revenue is rising, profits are rising, cash flow is, rising, right? So you can see again, value is rising over time. And for a company like Alphabet, you can see that the share price doesn't go too far away from the value. It goes slightly overvalued, slightly undervalued, right? And again, we want to enter ideally during times when it is slightly undervalued, because we know that over time, we will see an increase in the value of our investments. All right, so again, to summarize, one makes a very good business. One which is able to consistently increase its sales revenue, its net earnings, and its cash flow from operations. Now, here's the question. Can all businesses do this? The answer is no. Not many businesses can grow their top line and bottom line consistently. See, when a business is small, it's easy to grow because you've got a small base. But once you grow to a certain size, it becomes more and more difficult to keep growing at 10 or 20%. So what's the main thing that stops a business from growing? And the answer is competition. Competition. I mean, if you've ever learned a bit of economics, you know that when a business makes supernormal profits, when a business makes too good money, if there's a word for that, it attracts competitors. So competitors are coming in to eat your lunch. So competitors will charge lower prices. They'll come up with newer products to replace your product. So as a business, if you don't cut your price, what's going to happen? You're going to lose market share. You're going to lose your customers and your sales and profits will go down. But if you cut your price to compete with the competitors, what happens? It becomes a price war. You cut your price, they cut their price. You cut. And in the end, everyone suffers. Everyone's profit margin goes down. Everyone can't make money. And that's what happens to most businesses. But there are some businesses where in the long run, they can keep raising prices. And despite raising prices, they can still get more customers, retain customers, and grow their profits over time. How do they do that? Now, good examples of companies like these would be McDonald's or Nike or Ferrari, right? Notice that these companies, they don't compete on price because even if they charge higher prices, their customers remain loyal to them and more people want to become their customers. How are they able to do that? Because these businesses have something which I call, well, I don't call it, but people call it a sustainable competitive advantage. Warren Buffett calls this an economic moat. Now, what's a moat? A moat is kind of like, in the old days, kings live in castles. And castles were protected by moats, which is the water body around the castle. And they put a lot of crocodiles and snakes in there, right? So Warren Buffett says that a business is kind of like a castle. And you want your castle to have a wide moat with lots of crocodiles. Because when you've got a wide moat, it protects your customers, where competitors can't come in to take away your customers. When a company has got no moat, no protection, it can lose customers easily from new competitors. So we want a company with a wide moat. In fact, as one of the greatest investors in the world, Warren Buffett placed the greatest emphasis that an investment he goes into has to have a sustainable competitive advantage or economic moat. So that's what I look for as well. So what gives a company a moat? What gives a company this protection? Well, there are a few things. The first thing is known as a brand monopoly. So what does this mean? It means that the business has such a strong brand that it behaves like a monopoly. And how do you know that? Really simple. The moment you mention a product, 90% of people think of that brand as the first thought of mind recall. Okay, so here are a few examples. If you think of toothpaste, what do you think about toothpaste? What's the first brand that comes to mind? Toothpaste. Most people will shout Colgate, right? And sure enough, Colgate has a brand monopoly. If I mention a hamburger restaurant, what do you think about? McDonald's, right? It's a brand, again, it's a brand monopoly. If I mention pizza, home delivery, most people say Domino's. If I say pizza, dine-in, Pizza Hut, fried chicken, KFC, credit card, Visa, MasterCard, these are brand monopolies. And here's the interesting thing. If you take a look at any brand monopoly in the long run, guess what? The share price is always on a very clear uptrend, because a brand monopoly gives a company a strong moat, protection against competitors, right? So number one, brand monopoly. Number two, high barriers to entry. So here's an example, right? If you look at all the companies that manufacture commercial airlines, how many are there in the world? There are only two, Boeing and Airbus. So any plane you sit on is going to either be made by Boeing or Airbus. So the question is, why aren't there 1,000 companies making planes? Why can't you start a business tomorrow and compete with Boeing and Airbus? Because of the high barriers to entry. It costs billions of dollars to build the equipment and factory to make a plane. So because of this, these two companies are protected by competitors. And again, if you take a look at Boeing, in the long run, what happens? The share price will always go up because of its economic moat. Next will be high switching cost. What does this mean? So there are some companies that sell a product or service that once you use it, it's very difficult to change to another brand, because it takes a long time to learn how to use the product, or it takes a lot of investment to use the product in the first place. So here's an example. Have you heard of Adobe? Adobe is a company that creates software like Adobe Photoshop, Adobe PageMaker, that allows designers to design things using their software. And once people use Adobe, will they change to a new brand of software? Very unlikely. Why? Because many people, they go through years in design school to learn how to design using Adobe. So they spend all this time learning that software. It's really hard for them to change their software, right? Another example is Microsoft. Microsoft may not have the best software around, but we still use Microsoft Word, Microsoft Excel. Why? Because everyone's using it. And if everyone's using it, it's a lot more convenient to transfer files, right? And we call this the network effect, that since everyone is using it, we want to use it to make it more convenient for interaction. And also high switching costs, because since we are young, we are so used to using Microsoft Office and Word, it's really a pain to learn a new software. Does it make sense? Okay. Next would be the network effect. So like I mentioned, the network effect means that the more people that use it, the more people have to use it. And a good example would be YouTube. So if you want to create a video, you want people to watch your video, you want to watch videos, where do you go to? You go to YouTube. Why? Because everyone is creating videos on YouTube. So unlikely that someone else that creates another video website can pull away all the customers easily, because we've got vested interest into YouTube. What else? eBay. Again, if you want to sell a product, where do you go to? eBay. You want to buy a product, where do you go to? eBay, because everyone's there. Facebook, everyone's on Facebook or Instagram. So these companies have a network effect. So before you invest in a business, always ensure that it's got one of these qualities: brand monopoly, or high barriers to entry, high switching costs, or network effect. This creates a sustainable competitive advantage or an economic moat that protects your business from competition, and that will assure that in the long run, the company will be able to increase its sales, earnings, and cash flow from operations. Now, next question. No matter how good a business is, will it get into trouble one day? Sure. So every business may get sued eventually. Every business may make stupid mistakes that hits its profits. Every business will go through a recession or financial crisis. So a good business is one that's able to withstand any recession, any bad news. So how do we know the business we invest in is able to do that? Very simple. When the business has got low or conservative debt. See, if a company makes a lot of money, but it takes on a lot of debt in order to do that. It has to borrow a lot of money from the bank. What happens? It can be very vulnerable, because the moment there's a financial crisis and banks want to recall the loans and the company cannot pay back the loans, what happens? It can go bankrupt. Or if suddenly there's a huge increase in interest rates, the business has to suddenly pay a lot more interest on its borrowings. If it can't pay the interest, what happens? That's right, it could run out of cash and it can go bust. So we want a business with conservative debt, at the same time with a strong cash position. So when a company has got a lot of cash in a bank, it's able to survive any recession, and it's also able to buy up competitors during bad times, making it even stronger. So that's what makes a really good business.